Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.1 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover what algorithmic trading means and why it matters for traders. A simple real-world example of algorithmic trading in action, the most common mistake beginners make with algorithmic trading, a practical step-by-step way to apply algorithmic trading, and how algorithmic trading connects to risk management. By the end of this video, you will understand the fundamentals of algorithmic trading and be ready to start exploring this exciting world. Let's get into it. So, what is algorithmic trading? In simple terms, algorithmic trading is a way of using computers to automatically make trades based on a set of rules, called an algorithm. This algorithm can be based on various factors, such as market data, technical indicators, or even news events. The idea is to take the emotions and biases out of trading and let a computer make decisions based on objective criteria. For example, a simple algorithm might say, if the price of the euro to US dollar currency pair goes above 1.2000, then buy 1,000 units. The computer will then execute this trade automatically without any human intervention. Let's consider a real-world example of algorithmic trading in action. Suppose we have an algorithm that buys the euro to US dollar currency pair when the price goes above 1.2000 and sells when the price goes above 1.2200. On a particular day, the price of the euro to US dollar pair goes above 1.2000, triggering the buy signal. The algorithm automatically buys 1,000 units of the pair. Later in the day, the price goes above 1.2200, triggering the sell signal. The algorithm automatically sells the 1,000 units, making a profit. This is a very basic example, but it illustrates how algorithmic trading can work in practice. One of the most common mistakes beginners make with algorithmic trading is over-optimization. This means tweaking the algorithm to fit the historical data perfectly, without considering how it will perform in real time. This can lead to a phenomenon called curve fitting, where the algorithm is so finely tuned to the historical data that it fails to work in real time. For example, if we over-optimize our algorithm to fit the historical data of a euro to US dollar pair, it may perform well on historical data, but fail to make profitable trades in real time. It's essential to avoid over-optimization and test the algorithm on out-of-sample data to ensure it works in real time. So, how do we apply algorithmic trading in practice? The first step is to define the strategy, which involves specifying the rules for buying and selling. The next step is to backtest the strategy on historical data to see how it would have performed in the past. This involves running the algorithm on historical data and evaluating its performance using metrics such as profit/loss ratio and drawdown. Once we are satisfied with the backtest results, we can deploy the algorithm in real time. This involves connecting the algorithm to a brokerage account and allowing it to execute trades automatically. Algorithmic trading is closely connected to risk management. In fact, one of the key benefits of algorithmic trading is that it allows us to manage risk more effectively. For example, we can use position sizing to limit the amount of capital we risk on each trade, and we can use stop-loss orders to limit the potential loss if a trade goes against us. By combining algorithmic trading with risk management techniques, we can create a robust trading system that minimizes losses and maximizes gains. Let's consider a case study of successful algorithmic trading system. Suppose we have a system that buys the S&P 500 index when the price goes above its 200-day moving average and sells when the price goes below its 50-day moving average. Over a period of several years, this system has consistently outperformed the market with a steady upward trend. This is an example of how algorithmic trading can be used to create a successful trading system that generates consistent profits over time. While algorithmic trading can be a powerful tool for traders, it's not without its challenges. One of the biggest challenges is market volatility, which can cause even the best algorithms to fail. Another challenge is competition from other traders, who may be using similar algorithms to trade the same markets. To succeed in algorithmic trading, We need to be aware of these challenges and develop strategies to overcome them. As we look to the future of algorithmic trading, it's clear that this field will continue to evolve and become even more sophisticated. One of the key trends is the use of artificial intelligence and machine learning to develop more advanced algorithms that can adapt to changing market conditions. Another trend is the use of cloud computing and big data to process large amounts of market data and develop more accurate predictions. As a trader, it's essential to stay up to date with these developments and be prepared to adapt to the changing landscape of algorithmic trading. In summary, algorithmic trading is a powerful tool that can help traders make more informed decisions and manage risk more effectively. By understanding the basics of algorithmic trading and avoiding common mistakes, we can develop a robust trading system that generates consistent profits over time. Remember to always prioritize risk management and stay up to date with the latest developments in this field. With practice and patience, you can become a skilled algorithmic trader and achieve your financial goals. That is everything for Lesson 11.1. What is algorithmic trading? If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.